It's great to make money on property, isn't it? But then you also have to pay your dues to the government. That's taxes. So today we actually take you through various taxes that you might want to look into very closely or actually will have to pay in case you've sold your property. Vinay Singh, founder and owner, Vinay Singh and Associates, joins me as the expert on the show today. Vinay, thanks very much for joining us today. Let's go ahead and get our first caller online. We've got Abhishek Agarwal joining us. Hi, Abhishek. Go ahead. What would you like to know?
Yeah, hi. Yeah, good evening.
Good evening.
Yeah, first of all, I would say that the show is very beneficial. I have been a regular watcher of the show. So my question is that I actually had bought a property 1 year back and I sold it after 1 year, 2 months. And during that course of time, the circle rate actually changed. Initially, the circle rate was, let's say, 10,000. So now the circle rate is 15,000. And this has changed in only 5 to 6 months. So since the circle rates have changed so fast, am I liable for any tax to the government? Since I've already sold the property after 1 year and 2 months of purchase, number one. Number two, I also want to know as a curiosity that if I would have sold the property at the same circle rates, then what would have been the condition?
Okay, so this is a curious case, Vinay. What is applicable for him? He sold the property below the circle rates. That's what he's saying. But the valuation, property was 23 lakhs. Circle rates have increased to 43 lakhs.
We have a section 50C which was introduced on from 1st April 2003 essentially to combat black money. And what this section says is that if you are selling your property below the circle rates, then the circle rate will be treated as the sale price. So that's like a kind of a floor that the government sets for you. Now you have an option. If your argument is that the actual market rates are lower than the circle rates, then and you have not challenged it in a court of law, then the Income Tax Act gives you the option that you can approach the departmental valuer, the tax department valuer, and ask him to value the property. He will do a valuation, and if his valuation exceeds that of the circle rates, then the circle rates will be treated as the sale price, and if his valuation is lower, then the circle rates again will be treated as the, his lower value will be treated as the sale price. So this is the kind of system that has been worked out. So this is what Abhishek will have to see, that if his sale price is lower than the circle rates, then the circle rate will be treated as the sale price.
Okay, so you're saying that an independent valuation, not an independent valuation, but the tax authority valuation is possible if there is a wide difference between the circle rates and what you're getting in real, though I doubt if that's actually happening anywhere in the country, because circle rates were actually increased because they reflected more closely the market reality. But you do have an option out, Abhishek. You can get a departmental valuation done for your property, and then if it's lower, that's where you have to pay taxes. Saurabh G from Noida writes in. He says, I bought a ready-to-move-in apartment in Greater Noida in my name in May 2011. I borrowed 40 lakhs from HDFC to part finance the purchase. I sold off my house in Vadodara in February 2012 at 25 lakhs and used 100% of this amount to prepay the loan taken for my new house in Greater Noida. What are my tax liabilities? Straight questions. Sold one flat and repaid a home loan.
What happens in this case is that from the facts that he's given us, it appears that the index cost is about 12.29 lakhs and the capital gain is coming to about 12.71 lakhs. So since he has purchased a property within 1 year prior to the sale of this property, he is entitled to the benefit of section 54, which allows him a rollover benefit. Whatever gains that he has made have been invested in a new flat, and he need not pay any tax whatsoever. So I think he is pretty safe out there.
Okay, so you're safe out there. Actually, your entire tax liability goes away because you've invested the entire amount or bought a house just 1 year before the sale of your Vadodara property and used that money to pay up your home loan. We're going to take the next question, and this is Shami Nagpal says, I bought a under construction property in Pune and registered stamp duty paid on 18/10/2008. The project is now in April 2012 ready for possession. I wish to sell the property now. This is a curious one. Note this, my CS tells me that if I take possession from the developer now and then sell the flat, I will lose the benefit of long-term capital gains. Alternately, he advises me to make the last installment payable to the developer by the buyer directly and make a tripartite agreement with the builder and buyer and seller. In such case, I will get the benefit of long-term capital gains. Vinay, is it absolutely by the law or by the book?
No, it is not by the book, and these kind of tripartite agreements are more actually of a tax evasion device than of a tax planning device. If you see, last year itself, the Supreme Court had frowned, on transactions which are power of attorney related, because they tend to evade stamp duty and capital gains tax both. And the same thing applies to these kind of tripartite agreements. They tend to evade both of these taxes. So it's not legal, and by entering into a transaction like this, you are not going to be able to convert this into a long-term capital gain. So I would not advise him to go down this route. What happens is that for a house property to be called a house property, you first have to get possession, which happens post the occupation certificate, and then to get the benefits out of the sale, like for example for reinvestment, etc., you need to hold it for a minimum period of 3 years. So this is something that he will need to do if he wants to avail of all the benefits available to him under the Income Tax Act.
All right, Vinay, I'm going to get your opinion on one last question. This is from S.C. Mittal, New Delhi. He says, can you please clarify whether a long-term capital gain from sale of a property, if invested in a under construction property by a developer on construction linked plan but not completed within 3 years from the date of sale, will get qualified as investment for capital gains tax exemption? And you know, Vinay, we get this question every week, but we still take it because this is a very widely asked question.
Well, the test is not whether the construction has happened in 3 years, but the test rather is that you have made payments towards that and you've acquired sufficient domain over the property. Ideal, of course, would be that you have a registered agreement, but even if you have a letter of allotment, it's perfectly all right, so that you can at least identify the property. The flat itself, etc., should be identifiable. So if these conditions are met, even if the construction is not completed in 3 years because the developer is not able to do it, it's not a real problem. You can claim the deduction without any difficulty.
Vinay Singh, always a pleasure to have your views here for our viewers on the channel. Thanks very much for taking all our tax questions of the day. Okay, we're going to just take a very quick break, but when we come back, we will take many more cities and go through them in terms of where the properties are looking hot. Chennai is one of them. Meanwhile, you can also get in touch with us at property@ndtv.com or just call us at the numbers which are going to come up.